Hello again from Core Wealth. We are going to be covering the February 2022 market situation and wrapping up how things performed during that period. So if we look back over the last number of months and even more than a year with regards to Corona, that has been in the headlines, and the other thing of late has been global inflation. Now, the latest thing that has taken over those headlines has been the Russian invasion of the Ukraine. Now, this is a human tragedy, and the world, particularly the West, has reacted very strongly against this. The biggest impact on markets and economies, however, is on the supply side. Now, Russia is a big supplier of oil and even some grain into the West, and the Ukraine is a big supplier of a number of grains into the food markets in the West. And we've seen prices in those commodities jump up dramatically. Oil jumped from below $100 a barrel to over $130 a barrel, and grain commodity prices have increased considerably as well. This is really negative for global inflation. Now, it's not something that's definitely there to stay, and even on my way to work this morning, I was listening to a report where the UAE, which is a member of OPEC controls global oil supply, has agreed to try and convince its members to increase the amount of oil that they're selling, and that should have a positive effect, i.e. bring down the oil price. That in turn will then not have as many inflationary pressures on global inflation. So it is still a very up and down market. Things can change, and the markets are reacting very quickly to these things. But from a shorter term point of view, inflation is a big concern globally. So the big news in South Africa was our Minister of Finance, Enoch Godongwana, giving his budget speech in February. Now, a few things came out there. One, revenue collections for 2022 are around 182 billion rand more than was expected. Big tick there. The other thing was that our debt to GDP ratio as a country, in other words, our debt as a percentage of what the country produces, was expected to be around 7.9%. That's come in at around 5.7%. So a more than 2% reduction over what was expected, and this was because of this extra revenue collection. The other things that came out in the budget that were positive, one was economic growth. The Treasury is expecting economic growth in 2022 to be around 2.1%. It was 4.8% in 2021, slightly lower than what we'd expected at around 5%. We've seen some economists for 2022 predicting that it could be as high as 2.5%. So some economic growth coming through better than what we'd seen in those years prior to COVID. The other thing that was reaffirmed in the budget was that company tax is going to be reduced from 28% to 27% in the coming year. And the last thing was an announcement with regards to retirement funds. Retirement funds traditionally have had limits of 35% that they can invest outside of South Africa. That's been changed to an increase to 45%. You can now invest up to 35% in countries outside of South Africa and Africa, and an additional 10% into Africa, pushing it up to 45%. So we're starting to see a change in market performance compared to its medium-term history. The US, for example, had been the place to have been for a number of years, and that has changed in 2022. If we have a look at markets and we look at the global equity, the developed world global equity, we can see that was down 2.6% in February and is down 10.6% year to date. The US makes up the majority of that index. The emerging markets were also softer so far this year. In Feb, down just over 3% and down 7.9% year to date. But South Africa was a much better place to have been so far this year, up 2.9% in Feb and up 3.8% year to date. The South African listed property market was down quite strongly in February and is 6% down year to date, but this is after a really strong year in 2021 and has still given you a good medium-term return. If we have a look at currencies, we can see the rand has strengthened so far this year, which was something different again from what we saw in 2021. So if we have a look at 1 year, and I've added in a 2-year line into this graph, or into this table now as well, and longer picture, we are starting to see some things change, as I said earlier. If we look at the 2-year return column, you can see that actually the best place to have been since just before COVID, or at the time of COVID, to now for a South African investor has actually been in South Africa. You've had a return of 26.7% from the JSE compared to 18.6% from the Global Developed World Index and 9.2% from emerging markets. Just emphasizing that point that just looking back is not a good way to plan an investment strategy or run an investment portfolio. Just a comment on what we've seen in Russia, because that is one of the reasons that emerging market returns are so much lower, because of Russia and the China effect last year, where their markets came off quite a lot. The Russian stock market is closed at the moment, but was down, in fact, up to as much as 50% at one stage. Their currency has lost about 20% of its value. At the time the market was closed, their stock market was down just over 30%. Take another 20% because of the currency if you're measuring your wealth in dollars. And those wealthy oligarchs who have exposure to listed businesses on the Russian or the Moscow Stock Exchange have seen half of their wealth disappear because of this crisis and how the market is reacting to it. Now, that is one of the reasons why a lot of the commentators and research is suggesting that the sanctions could actually have a positive effect in forcing a more peaceful change in the Ukraine. The other thing that we can see from these slides is that cash continues to underperform inflation, and in fact the 2-year number now shows that even in that sort of medium term, cash has not been able to outperform inflation. And remember, on cash you usually have to pay quite a hefty tax bill as well. So something to think about if you are sitting on cash, that there are better ways to allocate that money and something to think about. The other thing, just to as in any situation, just have a look at the monthly wrap-up, and you'll see some of the shares that we've identified in South Africa that have been impacted in different ways by this whole Russian invasion of the Ukraine. Companies like Barloworld have been more negatively affected because they earn a lot of their earnings from Russia. Companies that have, like Sasol, that will benefit from a higher oil price, have actually benefited from this situation at the moment. So if we have a look at how this is fed through into our portfolios, they have continued to perform very, very well. We are seeing a bit of a purple patch at the moment and more tailwinds to our type of strategies, particularly the more valuation driven strategies, benefiting from how we've seen the market change in the last number of months and last year. So if you have a look through the slide at the moment, you can see that for the month of February, our local models all outperformed their peer groups and all generated some nice positive returns. Again, if you have a look over the 1-year period, some strong outperformance by a number of these portfolios relative to their peers. Remember, that's what's in brackets there, and that's really pleasing to see. And the absolute numbers over the year also looking strong, and most of them in double digits. Then if we have a look at the last column, which is since inception, and a number of these funds have been going for a long time now, you can see that all of the strategies have generated outperformance, and everything in green there, which is very pleasing for us to see. If we then move on to the global strategies, and again here we can see for the month of February a more conservative strategy, the defensive fund, outperforming peers well, but the absolute return in dollars was negative, and that is because of what we spoke about earlier, the things happening in global markets. Over the 1-year period, some slight underperformance, and the balance fund managing to give a little bit of outperformance versus its peers. a lot of that has been due to our exposure to emerging markets, has weighed slightly on some of those returns, but still over the longer term, which is now just over 5 years, heading for 5.5 years, we can see that generating some nice outperformance, and to be getting returns between 4% for a defensive fund and almost 9% on our aggressive fund in dollar terms really puts those strategies in a good position relative to their peers. So in looking forward, we're going to talk a bit more about this Russia-Ukraine impact. To start off with, there's a graph here that you can have a look at that just shows you the exposure within our portfolios, both locally and globally, to Russia. And you can see there that it's the largest portfolio, or the largest impact or exposure to Russia is only 1.1%, which is in our global US dollar portfolio, while our local portfolios have very little exposure to Russia. The other important thing to look at is, well, how much of the global economy and population do Russia and the Ukraine make up? And this next graph shows you that. You can see Russia is the red lines of both GDP and population. They only make up 1.8% of the world, and the Ukraine only 0.2% of global GDP, 0.6% of global population. So very small in the global context. The other important thing, however, is are there specific areas in which they yield or wield more influence than others? And the one is the energy space. And this next graph just shows areas that Russia has a large market share in terms of production. And you can see things like palladium, gas, oil, gold, wheat. The big one though is if we take gas and oil together, you can see they make up around 25% of the global energy supply, and particularly into Europe. And that is why we've seen a spike in energy prices globally, as well as in some of those commodity prices. And as I said earlier, it's really a function of whether the rest of the world will step in if and if sanctions are applied on those particular items. So history is a very good teacher, and we've taken some research here and looked back over the last 60 years and said, what did markets do when we had these geopolitical crises in the past? And if we have a look here, there's 16 different times that there were geopolitical crises in the world. Of those 16 times, it was only in 5 instances where the market actually fell more than 10%. Of them, only 3 of them were actually what would be considered a bear market, i.e. a retraction of more than 20%. Again, just putting things into context. Now, we're not saying this crisis won't have any impact. The biggest concern is probably the inflationary impact that it could have. But it isn't something to cause a dramatic reaction and sell out of a portfolio. The long-term diversified nature of a portfolio is what will pay off and ensure that your investments continue to grow. And that is something that we are focusing on and continue to do to make sure that we can grow our clients' wealth. I sometimes feel like I repeat this often, but it's because it's true in that stick to long-term strategies. If there are specific concerns you may have or questions you would want to ask, please by all means give your advisor or give us a call, and we'd love to chat to you about that.